All right, guys, welcome back to my mentorship series. This is episode 5, where we're covering draw, delivery, and entry. These are my 3 factors in any complete setup, right? Because a setup is more than just an entry model. When someone asks what system, what strategy do you trade, you can't just say you trade an IFVG entry model, right? Because that's all it is. It's just a way to get in on the move that the lower time frames and the higher time frames align with. A true well-rounded system involves multiple confluences and multiple time frame analysis, right? So what I'm always looking at is draw, delivery, and entry. And let's break that down. What does that really mean? Okay, so number 1, draw, right? Draw refers to sort of where you think the market is headed based on technical analysis such as liquidity, fresh fair value gaps, stuff like that, right? So draw acts like a magnet that is pulling price in a certain direction. Okay, pulling price. This is your pull factor. I say that to say, you know, if you're a visual thinker, if pictures help you, think of it as that sort of magnet that is pulling price, right? It's not necessarily pushing price from behind. Price hasn't interacted with this level yet, but it is pulling price in one direction or another, right? So this is usually some sort of higher time frame liquidity level. Let's say, you know, this is previous day high. This would be our draw. If the trend is already bullish on lower time frames and we have reason to move up, our draw in this case would be previous day high, right? That's pulling price. And vice versa, it could be pulling price down as well if we were bearish. Now, factor number 2 is delivery, okay? Delivery is sort of not the opposite of draw, but you can think of it as your push factor, right? This is what is causing a reaction in price, okay? We've already interacted with a certain level and it's causing a reaction, okay? So let's say we have sell side liquidity, right? And we just sweep it and we get a reaction to that. This is our delivery factor. Typically, this is paired with some sort of higher time frame fair value gap, but for the sake of example, we'll just look at this liquidity sweep here. Okay, so this liquidity sweep and the reaction we're getting, this is our delivery factor. This is what is pushing price toward our draw. So again, our example could be the same. This could be previous day high here. This is pulling price up. Our delivery factor is pushing price. So the way to think of it, draw has not yet been tapped. Delivery has been tapped. We've already had a reaction to it. So those are, you know, those 2 typically higher time frame based factors in any of my setups, right? And number 3 that everyone is familiar with is entry, which for me is always 1 minute and 30-second IFVGs. Again, entries are just a way to capitalize on your thesis, right? Where you think the market is ultimately going. You know, we want precision in our entry. We want to avoid unnecessary drawdown. So 1 minute and 30-second inversions are what I have found to be the most precise entries. I do know some people who trade 15-second inversions, but for me, that is way too much signals and it's just too much to worry about. 30-second is just fine. And the only time I'm really using the 30-second is when there's not any fair value gap present on the 1 minute to inverse. But if the 1 minute has a fair value gap and the 30-second does as well, I'll stick to the 1 minute. I'll wait for the 1 minute, right? I'm not going to front run the 1 minute entry just because the 30-second gives an inversion first. So draw, delivery, entry. Take a screenshot of this, write it down, visualize it, right? Magnet, push, and precision entry. So let's take a look at that in the charts. What does that really look like? Well, this is today's action. I'm filming this on January 6, 2026. Today we were an inside day prior to the New York Open. That means we hadn't taken out yesterday Monday's high or low, and we had previous day high, Monday's high here up above. So this was our midnight open right about here. You see price came up, failed to make any new high, right? We didn't break above previous day high, came down and actually swept some internal sell side liquidity. Now I'm not using this for any trade logic. This is just my overnight pre-market analysis, right? So what happened? We opened up midnight, we came up, we failed to break above and go outside of yesterday's range. Sold off, swept some lows that were created in the afternoon session on Monday, and then reversed. So ahead of the open, we were climbing up, and we had not only high of day, but previous day high as our higher time frame draws. So that's my first thing when I'm coming into the market and I'm doing my pre-market prep. What is my higher time frame draw on liquidity? And if you guys are in the Discord, you know that every morning I post that analysis for everyone to read and to see. So today for me, that was 25,708.5 being my New York AM session draw on liquidity. We opened up on this candle here. This is a 5-minute chart. We opened up, we did sweep high of day, but we were holding bullish PD arrays, right? And specifically this 5-minute bullish FVG here. I noted this as my point of interest, right? My bullish PD array that I was watching. This was created just after the 9:30 open. We came down, we tapped it, and we dug further, fully rebalancing it, right? So this was my sort of push factor for any longs. I have my draw, I have my delivery being this 5-minute FVG, and then when we drop down to the 1 minute, you'll see the perfect entry. Okay, here's that 1 minute. So I'm gonna get rid of this. This was that 5-minute FVG, but you'll see this breakdown here on the 1 minute. As you can see, we've inversed quite a few 1 minute bullish fair value gaps. I don't really care too much about that. What I'm looking at is a bearish FVG to form, which did indeed form here. And you see we got our perfect inversion close right here. This is everything falling into place, right? My draw, my delivery being that 5 minute, and then my 1 minute IFVG entry. So those are those three factors, right? Now, how do we actually take a trade based on this? Well, we simply buy this close because we are in a discount of our New York range, right? I don't really need to wait for any sort of retracement. Me personally, you guys know I like scalping. I like going for the low-hanging fruit and just stacking wins. I would be taking profit at high of day, right? Not previous day high, even though that is my draw. Just something to keep in mind. Your draw doesn't always have to be your exit. You don't need, to demand perfection from the market. For me personally, I can have a draw, but I'm going to be getting out before my draw most of the time, right? Anytime price has a reason to reverse, so in this case, we could sweep high of day and reverse, I'm going to be getting out then, right? So my draw is pulling us up. I have my 5 minute as my delivery pushing us up, and now I have my 1 minute inversion entry. My stop loss in this case, depending on how risk adverse you want to be, can be, the mean threshold of this order block or the low of this 1 minute displacement candle. This is the safer option, and it's what I would opt for. So if we measure our RR here, should be something like 2, or just above 2 risk to reward. Yeah, so about 2.1 risk to reward. Phenomenal with this strategy, as you guys know. And this is how the trade played out, right? Just 3 minutes straight to TP. This is where I'd be closing it. And then I believe we delivered straight to previous day high shortly after that, right? This is an example of a really strong draw on liquidity. We're aligning with the trend. We're waiting for pullbacks. We're waiting for delivery arrays to cause reactions, and we're getting our precision entries, right? We're not really sitting through any drawdown. As you can see, we bought and the market pretty much took off after that. I actually took a 30-second inversion today in this range as well, right? Just because there weren't any 1 minute formations until this one here, and I got out somewhere over here, and then this following 1 minute trade also played out. So this is a real-time look at draw, delivery, and entry. Let me give you guys an example on the short side now. All right, now that you guys have seen one example of draw, delivery, and entry, right? In that last example, we were using a 5 minute fair value gap as our delivery, and we were using previous day high as our higher time frame draw on liquidity. I just want to outline a few more examples of draws, right? So a draw on liquidity can be that, right? Liquidity in the form of a higher time frame swing high, swing low, or equal highs, equal lows, relative equal highs, relative equal lows. So if you guys go back to, I believe, episode 3, we cover all of these different types of liquidity, right? But equal highs, equal lows, they're equal if they're exact to the tick. Relative just means they're off by a few ticks, right? But let's look at an example of that. This is a perfect example of relative equal highs and lows here, right? So we have these lows here in the market, and then we had price come down and didn't sweep it, but left a higher low. So anytime we have an old low and then a higher low that comes really close, that creates what's known as relative equal lows. Okay, so perfect example of a bearish draw on liquidity, in this case being these relative equal lows, which we'll come back to here in a second. Another form of draw on liquidity can be fresh fair value gaps, right? Why? Well, if you go back to our last episode, episode 4, fair value gaps are imbalances in the market, right? So let's draw one out real quick. As you guys know, it's a 3-candle pattern, 1, 2, 3. And anytime they have not been rebalanced at all, these act as a magnet. So in this case, a bullish fresh FVG can act as a bearish draw on liquidity because price wants to come down and at least tap it once, right? Now, whether or not it fully rebalances it or closes below, gives an inversion, that doesn't matter. In this example, I'm just referring to a fresh FVG acting as a draw on liquidity, right? Makes sense. It's an imbalance that wants to be rebalanced. So these are the different types of draws on liquidity. Now let's go over various delivery factors. Like I said, we covered a 5-minute FVG acting as a delivery factor, but there are other types of delivery factors. Okay, so Liquidity sweeps. That's another example. Anytime price sweeps liquidity and has a reason to reverse, right? So something like this. Let me make that a bit neater, right? If we swept sell side liquidity, we have a strong bullish draw above. This is a a delivery factor. This sweep here, like we covered. Vice versa for a buy side sweep. If we have reason for price to reverse and come back down, that buy side sweep would act as a delivery factor. FVG and order block reactions, just like we saw in that 5-minute example. Anytime price reacts to a fair value gap the way it should, right? If it taps a bullish FVG and then bounces back up, that's a bullish reaction. That FVG is holding. That's a reaction, right? That's a delivery factor. Same thing with order blocks. If we tap a bullish order block and price reacts to that, that is a bullish delivery factor that you can use in your trade thesis. The last factor that we haven't covered yet, but we will right now, are premium and discount reactions. What do I mean by that? So if you've spent any time in the world of trading, you've probably heard of Fibonacci levels, right? I don't use those golden levels like the 0.618 or 0.72, whatever those are. I don't use them at all. The only way I use fib levels are for 0, right? 50 and 100% of a range. What do I mean by that? Let's say we have a swing low in the market. We come up, we establish a high, and then we retrace. I'm concerned with how far this retracement dug into that range, right? This is our established range, our dealing range in ICT terms, our low, our high. And obviously halfway of this is 50%. So discount, you'll hear me say discount and premium. Discount is below 50% of this range, right? Premium is above 50% of this range. If I'm looking for longs, a potential delivery factor for me is price coming down into a discount below 50% and reacting off of it. Again, remember, delivery is a factor that's already occurred in price. This is the push factor. So we've already tapped into a discount. Now let's say down here we get an inversion, something like this. This could be a perfect delivery reaction for me to go long. If we get that inversion, we have a bullish draw occurring and we have our bullish delivery in the form of a discount reaction. This is a perfect long for me, right? I still get all those three factors. Although it is a different form of delivery, it's still a very valid delivery array. Vice versa, if we look at a short example, again, just using premium and discount. Premium will always be the top 50%, by the way. Discount will always be the bottom 50%. Right, basic, if something is cheap, it's in a discount. If something's expensive, it's in a premium. Right, so let's say we establish a range here. We form a high, we come down, we form a low. This is our dealing range. Anything above 50% is a premium, anything below is a discount. If I'm looking for shorts, I want price to retrace into a premium above 50% before coming back down. This would be my bearish PD array that is providing delivery for any short that I might be looking to take. Let's say we get an inversion like this. This is valid for me, right? As long as we have a bearish draw pulling price down, we get a reaction to our premium here with price rejecting it. And we get that entry with our inversion model. This is a valid short for me. The basic fundamental thinking behind all of this is, okay, well, 50% buyers want to be buying below 50%, sellers want to be selling above 50%. So anytime we react with these levels, we have reason to ensue in the original trend, right? So if we don't quite tap a premium, this doesn't count for me. Let's say we get close, but we don't go above 50% of this clear range. This is not a premium delivery for me because we haven't tapped that 50%. It's a retracement, sure, and we could still get, an FVG reaction. Let's say this is a 5-minute bearish FVG. That could still be, our delivery factor, but we don't have premium delivery in this case, right? So let's look at a real-time example of premium and discount being a delivery factor in our trade, right? So let's look at this chart here. This is a 1-minute chart. Again, I'm sticking with a 1 minute because that's where my entries occur. Right, what do we have? This was the open. We have price come up. We actually swept a ton of buy-side liquidity over here, even further back there, but we'll just mark out this buy-side sweep. We had the market briefly come down and then come up once more to sweep high of day that had formed in the New York session here. So quite a few buy-side liquidity sweeps. We had a downtrend establish, but we didn't have price take out these lows. So we still have a bearish draw in the market being relative equal lows. So we'll type that out. Relative equal lows. This is our downside draw. Number one, again, always remember, is our draw on liquidity. In this case, relative lows. Now I'm looking for delivery factors. First thing I always see are imbalances in the market. So I'm going to immediately mark out this 1 minute bearish FVG. You see we've dug into it. We've pretty much fully rebalanced it. We didn't close above, right? So we're respecting a bearish PD array for what it is. So that's one delivery factor. But if we look closely, if you guys think about what I just said, this is our dealing range. Very obvious high in the market, very obvious low. I'm not using this low because this was presented prior to the session. But our New York session here, we have our high and we have our low. And I'll clear some of these drawings out. What did we just tap into? And what are we rejecting? A premium, correct. This is above 50% of our range. From New York high to New York low, this is that premium range which price is rejecting. It spent less than 3 minutes in this range and it's come back down. So not only do I have this bearish 1 minute FVG providing downside delivery, but I also have premium delivery in this short. And if you are getting the hang of this, you'll see we also get a bearish inversion here. Remember, a bearish inversion is a close below a bullish FVG. So there is, that perfect trinity of confluences, right? We have our bearish draw, we have our bearish delivery, and we have our bearish entry to capitalize on a short. So all that's left to do here, sell this close. Target, ultimately this swing low if we think we're going to go to these relative lows. And based on your risk tolerance, put your stop. You could put it within this order block here or at this swing high. Again, shooting for about a little more than 2 to 1 risk reward here. Let's see how the trade plays out, right? Again, I'm just selling immediately at this close because we closed pretty close to our fair value gap that was inversed, and I'm going to let the trade play out. Now you could go break even once we tap this lower FVG, and you could potentially exit. This is still a great amount of points. It's over 35 points to this FVG. If you wanted to do more of a scalping model, which is what I teach and trade to maintain a higher win rate, you could adjust the trade to look something like this, right? Stop going at the high of this displacement candle, entry at the close just like we did, and then exit at this fresh FVG. 1.2 risk reward. Yes, it's scary to a lot of people and it doesn't seem right. But when you're winning 80-90% of trades, which is very, very possible with strong draw, delivery, and entry, this is phenomenal risk reward, right? I'll take this any day. But for the sake of illustrative purposes, let's go back to this original trade idea and let's see how it plays out. As you can see, that draw is indeed pulling us down, and we get our exit on this candle here, right? Draw, delivery, and entry, guys. It's really simple to understand. Right, and it's just those multiple confluences aligning. We want more than just an entry model. We want more than just an idea of where the market is headed. We want everything to align, right? Your job as a trader is to just be patient, wait for everything to align, and put risk on when you're called to do so, when it's appropriate, right? And if the setup is A+ and you do indeed have your draw, delivery, and entry, you should feel absolutely confident in putting risk on and just knowing that probabilities will take care of themselves. Right? If I have an A+ setup, I'm happy to put risk on. I don't care if it's a winner. I don't care if it's a loser. My back-tested data, my forward-tested data has shown me what my win rate is, what my expected value is. Right? So I know I'll win most of these trades, and in the long run, I will make money as long as I can control, my losses and stick to execution on A+ setups. So this has been episode 5, draw, delivery, and entry. Right? You guys have learned the entry model in the last episode, IFVGs. Now you're piecing it all together. So go ahead and backtest this, right? Look for those various factors. Look for inversions on the 1 minute. Look for delivery factors like premium and discount. Look for 15-minute, 5-minute FVGs, and look for your higher time frame draw on liquidity. If you guys are enjoying the series, please do share it with someone you think it would help. Leave a like, subscribe, and keep an eye out on all of my content, right? I post daily short form videos, so bite-sized education clips go up every day on my YouTube, my TikTok, my Instagram. Give me a follow, guys, and engage with me. Join my Discord, link down below. Hope to see you in there. Thanks.